your focus should be what? On managing your capital. Why are a lot of people being scammed? They focus more on the reward than the risk. That is why a lot of people fall for scam. When a trader offers you or someone offers you a certain amount of return on investment, you are more concerned about the return on investment, but they will never tell you the risk involved. And I see no reason why you should invest in a business or the financial markets if you don't understand the risk involved. What differentiates a professional trader from a gambler is their ability to manage risk. I don't care what strategy you're trading with. If you can't manage risk, you will keep losing money in this market. Now, the first thing we'll be looking at here is the different types of accounts. We will look at the different types of accounts you can operate with a broker. Then we'll look at what leverage is. You need to know this before we look at other topics under risk and money management. So there are 3 major types of accounts you can operate with a broker. Sorry for that break. So 3 types of accounts you can operate with a broker. We have the standard, we have the mini, and we have the micro. Now, to operate a standard account, you need $100,000. To operate a mini account, you need $10,000. And to operate a standard, micro, you need $1,000. Now, you can't afford $100,000 to operate a standard account. You can't afford $10,000 to operate a mini account, and you can't afford $1,000 to operate a micro account. What do? You apply for what we call leverage. So you want to operate a standard account, which is $100,000. Now you can't afford $100,000. What would you do? You apply for leverage. Now, what leverage would you apply for? Let's say the capital you have or what you want to invest is $200. Now, the leverage you need to apply for in this case is what? 1:500 leverage. What this means is that with $1, you would be able to purchase 500 units worth of currencies, which is $500. Now, since you have $200, $200 multiply 500. If $1 gives you 500, then $200 will give you 100,000 units worth of currencies. So with your $200, you can trade or you can purchase the same quantity of currencies the trader who has $100,000 in his account would purchase. That's the benefit of using leverage. Without leverage, the individual trader wouldn't have access to the market. So we really need to appreciate brokers for the privilege granted individual traders to participate in the market. Without leverage, you can't, unless you can afford $10,000 or $100,000. So most individual traders request for leverage. It's very important. So if you apply for, let's say you have $500, can somebody tell me what leverage you would apply for if you want to operate a standard account? If you know it, please type it in the comments space. You have $500 and you want to operate a standard account. I want you to comment if you know it. What leverage would that be? I'm waiting. Does anyone know? I believe you all can hear me. Can you all hear me? So you have $500 capital, but you want to trade a standard account. What leverage would you apply for? Can you all hear me? Mr. Ahmed, can you hear me? Ebuka, can you hear me? Mr. Niola, can you hear me? Mr. Jeremiah, Mrs. Messi, can you hear me? Does anyone know the leverage I would apply for? No? Yeah, Mr. Ahmed, you're right. Not 1:1,000, but 1:200. If $1 gives you 200 units, then your $500 would give you 100,000 units. Few minutes, please. Sorry for that break. So that will be 1:200. Now, let's say I want to operate a mini account of $10,000 and I have just $200 capital. What leverage would I apply for to be able to operate a mini account of $10,000? If you know it, please type it in the comment space. Does anyone knows the leverage? Okay, that's then for 10,000, Mr. Ahmed. 10,000, Ebuka. I want to operate a mini account, but what I have is $200. What leverage would I apply for? That should be 1:50. Not 500. It's 1:50. 200 times 50. That's 10,000. That's 10,000. 1:50. If I have $100, what leverage would I apply for? If I want to trade or operate a mini account, what leverage would I apply for? I have $100. I want to operate a mini account. What lot size would I apply for? If you know it, type it in the comment space. What leverage would I apply for? I have $100 and I want to operate a mini, sorry. Thank you, Mr. Ahmed. That's 1:100. Your $100 multiply 100 gives you 10,000. Now, just as we have the different types of accounts, there are minimum and maximum lot sizes that can be traded on each account. For the standard, the minimum standard lot is 1.0. Infinity. That's for standard lots. Then for mini lots, the minimum is 0.1 to 0. And for micro, the minimum lot size is 0.01 to 0.09. Now, 1 pip on one standard lot is 1.0 lot size equals $10. So 1 pip on 2 standard lots, which is 2.0. That's $20. And let's move to mini. 1 pip on 1 mini lot is 0.1 equals $1. 1 pip on 2, which is 0.22 mini lots, equals $2. Let's move to micro. Micro 1 pip on 0.01, which is 1 micro lot, was 10 cents. One pip two micro lot, which is 0.02. That's 20 cents. So those are the different lot sizes on the different types of accounts. Now, before you execute a trade, I've said this over and over again. you must define the risk on the trade. Before you execute the trade, define the risk and also reward. Define the market risk, or you should know the market risk. But before knowing the market risk, you should define capital risk. Capital risk is the risk you are willing to take on every trade you execute in the market. Then the market risk is defined by the market. You don't define the market risk. The market tells you the risk that is involved in every trade. Then the reward, it's your responsibility. You need to define the reward and define the capital risk. So let's say your capital is 1,000. Let's say you have a capital of $1,000. Now define the capital risk, and that should be in percentage. What percentage of your capital do you want to risk on every trade you execute in the market? Now, you are advised not to risk more than 2% on every trade you execute in the market. You can risk more than that, but you are advised not to risk more than 2%. Like on one of my accounts, on every trade I execute on that account, I take the risk of, I think my risk on that account is like 8 to 10% on every trade I execute in that on that account. My risk is like 8 to 10%, and I'm able to double the account in the space of 3-4 weeks. I was able to double it. Now you should understand that the higher the risk, the higher the reward. Now, someone who is trading with 2% can't double his account in 1 month. You can't double your account in 1 month if you are risking 2%. On one of my accounts that I risk 2% on every trade, I've been able to make 50% in the space of 5 months. You can see, and that's because my risk on that account is low. But on the other account, I'm taking a risk of 8 to 10% on every trade. I've been able to double the account in less than 4 months. So the higher the risk, the higher the reward. The lower the risk, the lower the reward. But ensure that every risk you take in the market, you are comfortable with it. Ensure that you are comfortable with every risk you take in the market. If you are trading, or if you have trade running and you're unable to sleep at night, it means you're trading above the risk, or you're trading above your risk limit. So ensure that whatever trade you execute in the market, it is within your risk limits. That means you're comfortable with the risk. So let's say you have $1,000 and you're taking a 2% risk on every trade. Means on every trade, your capital risk will be $20. So you have defined your capital risk. You must know this before you execute a trade. Immediately you fund your account, you know that on every trade, you would not risk more than $20. The market defines the risk, the market's risk, okay? So how do you define market risk? Market risk equals entry price minus stop loss price. It's your risk. So let's go to the charts. So here is a trade setup to sell Euro USD. So this is a spinning top. And when you see a spinning top in an upward trend, you wait for the next candlestick to close bearish before you sell. And if the body of the spinning top is bearish, you can Hello? Okay, sorry for that break. So as I was saying, since the body of this spinning top is bullish, you would have to wait for the next candlestick to close bearish before you start selling. But if the body of this spinning top is bearish, you can risk selling after the close of that spinning top. Since the body of this spinning top is bullish, it is an indication that you still have few buyers in the market. And before you enter a trade to sell, you must be sure that you have enough sellers in the market before you enter a sell. That is why if the body of the spinning top is bullish, wait for the next candlestick to close bearish before you what? Sell. So here we have a sell setup. So this is a bullish spinning top. Then we are entering a sell trade after the close of this candle. So this would be our entry price. Let me change the color so that you can see it clearly. So this is our entry price. So we are selling from this price. So where do we set our stop loss? If you are selling, your stop loss is always above your entry price. And if you are buying, your stop loss is always below your entry price. So where do we set our stop loss? Our stop loss should be at this level. Why? If price goes up after the close of this bearish candlestick, if price goes up and closes above this level, there is a high probability that price will keep going up. And since you know at this point that when market closes above this level, price will keep going up, then your stop loss should be at that level. You don't want to hold on to a sell trade when the trend has changed to bullish. You don't want to hold on to trade. So if you execute a sell here and price decides to go up, you should exit that sell at this point. So that will be our stop level of stop price. So our entry is 1.1356. 1.1356 minus and our stop loss is 1.1375. Now, what's the difference here? 1356, 1375. I think that's 19 pips, right? 19 pips. What is a pip? The full meaning of pip is percentage in points, and it is the unit we use in measuring price movements, pips. So the risk on this trade, the market risk, is 19 pips. Now, on this risk, you are willing to risk $20 of your capital on this. So what do? What we want to know now is the lot size to apply on this trade. We want to know the lot size for this trade. You don't just use any lot size on a trade. So I want to show you how to know the appropriate lot size to use on every trade. As you know, this value will always vary. And as it varies, the lot size also would vary. So let's see how to calculate the lot size. So to get the lot size now, you divide your capital risk by the market risk. So let's divide. The capital risk is 20, divide 19. So what do we get? 20 divided 19. If you have a calculator, you can help me out. 20 divided 19. What do we have? That's 1.05. Am I correct? 20 divided 19. Okay, 1.05. Okay, thank you. So this is $1.05 per pip. What we did here is just like sharing $20 amongst 19 persons. So if you share $20 amongst 19 persons, each person will go home with $1.05. Each person will go home with $1.35. So what lot size would give you $1 per pip? If you know that, please type it in the comment space. What lot size would you use that would give you $1 per pip? If you know it, drop it in the comment space. What lot size would you use that would give you $1 per pip? I mentioned it when we're looking at the different types of of lots, different type of lots, standard, mini, and micro. So what lot size will give you $1 per pip? Yeah, Mr. Ahmed, thank you. That's 0.1. Okay, Mrs. Hope or Mr. Hope, thank you. 0.1. Thank you. So the lot size on this trade is 0.1. That is the lot size you will apply on this trade. Now, if 1 pip on this gives you $1 and your risk, the market's risk is 19 pips, it means if the trade goes against you, you would lose $19, which is less than the $20 risk. So it's best to take a risk that is less than what you're willing to take than taking above what you're willing to take. If we had used this 1.05, maybe by the time we multiply 1.05 by 19, we would have maybe like 20 or 21. So the best lot size to use in this case is 0.1. Ensure that you're not taking a risk that is above what you're willing to lose or risk on every trade. So this is 0.1 lot size. Now, for those who don't know how we arrive at this value, you can just multiply whatever value you get here, just multiply it by this constant, 0.1. So if you multiply whatever value you get here by 0.1, you get the lot size. So let's multiply 1.05 times 1.05 times 0.1. Okay, that's 0.1. So this is the lot size for this trade. So let's take another trade. Let's go back to the chart. So here we have what we call armor. This is an armor, and this is a bearish armor. When you see this kind of formation, you don't just jump in and start buying, because the body of this armor is bearish. This is an indication that you still have sellers in the market and they can keep pushing the price down. So before you enter the trade, you have to wait. You need to be sure that you have buyers in the market. And how do you confirm that? Is by the formation of the next candlestick after the hammer. So you have to wait for the next candlestick to close bullish, as we have it here, before you want buy. Now, on this trade we took now, the risk is 19 pips. Now, what will not be your reward on this trade? On every trade you execute, your risk-reward ratio shouldn't go below 1:1.5. On every trade you execute, your risk-reward should not go below 1:1.5. Never trade with risk-reward ratio 1:1. If you're trading with risk-reward ratio 1:1, you won't be profitable in the long run. You will just be playing in the market, turning in circles. You make profit today, you lose it tomorrow. You make profit in 1 week, the following week, you lose it. So never go below 1:1.5. This is my secret of profitable trading. I apply good risk-reward ratio. If the trade will not give me a reward of 1.5 to risk of on a risk of 1, I would not execute the trade. So what this means is that for every $1 risk I take in the market, I must make $1.5. That is my target. So if the risk on this trade is 19 pips, then my profit will be what? All I need to do is multiply this 19 pips times 1.5. You can use 1:2. You can use 1:3. Okay, when the risk is less than 50 pips, as we have it here, this 19 pips, you can use 1:2 or even 1:3. When the risk is less than 50 pips, you can use risk reward ratio 1:2, 1:3. But if the risk is as high as 50 pips, your risk reward ratio should be 1:1.5 or maximum 1:2 if the risk is as high as 50 pips. But anything less than 30 pips, you can use 1:2 or 1:3. Please note that. So our profit target on this trade, let's just use 1:2. So 19 times 2. So your profit target will be 19 times 2, that's 38. 38 pips. And since you are selling, you expect price to fall. You expect price to fall. So if our profit target is 38 pips, what is our entry price? Our entry price is 1.1356. So we'll subtract 38. Since we expect price to fall, we'll subtract 38 from this. If we were buying, we will add 38 to our entry price because we expect price to go up. But since we are selling, we will subtract what? 38. So subtract 38 from this. I think that is 18, right? 38 from this is 18. What we have is what? 1.1318. That will be our take profit. 1.1318. This is our take profit. This is our risk. You can see this is 1:2. And we actually, the market hit our profit targets. Even still went below our profit target. You can see. Don't be greedy. Don't say you want more. Your risk defines your reward. Don't say you are risking $20. You are aiming for $100. Truth is, before markets will get to that $100, it will reverse. So let your risk define your reward. If your risk is 20 pips, aim for 30 or 40 pips. If your risk is 50 pips, aim for like 80 to 90 pips. Don't say you are risking 50 pips, you are aiming for 400 pips. It will take weeks, if not months, before it will get to 400 pips. So let your risk define your reward. So let's execute one more trade. So on this, so we'll wait for this candle to close before we buy. Now, if the body of this candle, this armor, is bullish, that's a confirmation that you have buyers in the market. So you don't have to wait for the next candlestick to close bullish, because the body of the candle already confirmed that you have buyers in the market. But if it is bearish, as we have it here, you have to wait for the next candle. This is the candle that confirmed that we have buyers in the market. So we are entering a buy after the close of this candle. So this will be our entry price. Now, if I'm buying from this point, then your stop and our stop loss should be around this level. So this is our entry price, 1.1314. $1.1314 minus our stop loss price, 1.1264. This gives us our market risk. So let's subtract this. 1314 minus 1264. That is 50 pips. We are risking 50 pips on this trade. And the risk we want to take on our capital is $20. What lot size would we apply on this trade? So our market risk is $20. No, sorry, our capital risk is $20. Market risk is 50. So we have 20 divided 50. And that's 0.4. Divided 50. That's 0.4. So each person will go home with 40 cents. What lot size would give us 40 cents per pip? If you know it, type it in the comment space. What lot size will give us 40 cents per pip? Type in the comment space if you know it. What lot size? I'm waiting. Thank you, Mr. Folosho. 0.04. So as the market risk varies, the lot size also varies. Now let's see if, so our profit target, since our risk is 50 pips, then our target should be 75 pips. That's 1:1.5. $75 pips. 75 minus, this time we are buying, so that will be a plus. So 75 plus 1.314, that would be 1.389. 1.1389. So that's our profit target. 1.1389. So that's our profit target. Well, the market got to this point and the trend changed. Price started dropping. So you executed a trade from here. Your risk was 50. And on that trade, you made a profit of 60 pips. Market went in your direction, 60 pips. What would you do? Would you wait for the market to get to your take profits before you close this trade? If you had waited for market to get to your take profit level, you definitely would have lost on this trade because price fell and it went below the price you entered the trade. So if you had waited for the market to get to your profit target, you would have lost on this trade. So what would you have done in this case? The best thing to do here is to trail your stop. Trail your stop. When you make profits on the trade, you should consider reducing your risk on the trade. It's not just about executing the trade. How you manage the trade after execution is very important. That will determine the end result of that trade. It won't be wise for you to lose or to record losses on a trade that had given you, you've made so much profit, just left with, I think, 15 pips to get to your take profit target. What you should do in this case is to trail your stop. Your initial risk was 50 pips. Immediately, the market moves in your direction with 50 pips. You should adjust your stop loss to your entry price. So you take your stop loss from this point to this point. So if markets or price decides to fall, you will no longer lose on this trade. Because if price falls, it will close at your entry level. So it will be break even. You would not lose on this trade. But what most traders do, and that is why they are not profitable in the long run, is that they leave this trade before it hits their stop loss. They will leave the trade, hoping that it will get to their profit targets. But the market didn't get there. And at the end of the day, they will close this trade at a loss. So if your risk is 30 pips on a trade and the market moves in your direction with 30 pips, then adjust your stop loss to your entry price. You shouldn't lose on a trade that you have made so much profit on. That is, the profit is equal to the initial risk you took on that trade. You shouldn't lose on that trade anymore. You can even move the stop loss 10 pips above your entry level. So if the market reverses, at least you still make 10 pips on that trade. If you apply this on or in trading, you'll be profitable in the long run, irrespective of the strategy you're trading with. Apply this risk management strategy, which is trading stop. Apply it on every trade. You'll be profitable in the long run. So never let a profitable trade turn loss. So on this trade, at least you should go home with at least 10 pips. You should go home with 10 pips because you made 60 and your risk was 50. So you should adjust your stop loss 10 pips above your entry level. So don't just execute the trade and leave the trade. You need to monitor the trade to ensure that you get the best out of that trade. Okay, let me stop here and take questions before maybe look at other topics. Let me just take your questions. Next 10 minutes, we'll be taking your questions. If you have a question, please raise your hand up. Let me attend to your question. Okay, Mr. Folonsho. You can unmute yourself, Mr. Folonsho.
Evening, sir.
Mr. Aniola, I will meet you in a few minutes. Okay,
Evening, sir.
good evening.
Sir, I want to ask, how do you define the trend of a market, sir?
Candlestick.
Can you hear me, sir?
I use candlestick formation.
Okay.
Okay, I use candlestick formation. I use pivot points. I use zigzag indicator. Yeah, those are the three, and resistance and supports. That is what I use for analysis.
Okay. Okay, sir. And let's say I'm opening 2 positions on the trade. Am I going to use the same stop loss, or I would use different stop losses?
If you're opening what?
2 positions on one currency pair, sir.
2 positions on one currency pair.
Yes,
So if
like
you have, let's say, 2 positions on one currency pair, right?
Yes, sir. Yes, sir.
Okay, your risk is $20. Okay. So on one pair, then your risk should be $10 on each trade.
Okay.
Okay.
Okay, sir.
This is what I do. If my risk on a trade, I'm sharing my secrets. If my risk on a trade is 50 pips, this is what I do. So this is what I do. I will execute 2 trades on the same pair. My first stop loss will be between 30 and 35 pips. And the second stop loss will be 50 pips. Okay, 35, 50 pips. So if my risk on every trade, please, Mr. Folonsho, there is noise coming from your hand. You can. So if the risk is on 50 pips and 35 pips, and I'm willing to lose $20 on this trade. Okay, so if I use 0.02 on this, that will be $10. Right?
Yes, sir.
That will be $10. And if I use 0.02 on this other one, that will be how many dollars? $7. That will be my risk. So I will be risking $17 instead of
$20.
$20. Yes, so I still have $3 left.
Okay.
Okay. So in this case, if I'm risking $10 on this trade, my profit target 50 pips. My profit target will be 75 pips. So that's 75 pips. 0.02 times 75. That's $15. So I'm risking $10 to get $15. On this other trade, I'm risking $7, and my profit target on this trade will be 50 pips. So you can see this other trade, when the market goes in my direction and gets to 50 pips, I would close. So I would have secured the risk on this other trade. Do you get that?
Okay.
So this one will be 50 pips. 0.02 times 50. That's $10. So I'm risking $17 to get $25.
Okay.
So this second trade would secure the risk I'm taking on this trade. So once this one hits my 50 pip profit target, I would adjust my stop loss on this one to break even. So if the market or if price decides to retrace, now I've closed profit of $10 and I've adjusted my stop loss here to break even. So I can no longer lose on that trade. Well, I've already collected $10 from the market. Understood?
Yes, sir.
Whatever strategy you're trading with right now, apply this strategy for 1 month.
Okay.
You'll come back with testimony. Apply it for 1 month. Mr. Ayala.
Good evening.
Good evening, sir.
Sorry, when you were doing the stop loss and entry price and stop loss, you eventually arrived at take profit. Where did you get your 75 plus 1.1389 to get take profit in your chart? The 75 values, what I do.
What was the risk? Can you remember the risk on the trade?
The risk is 50 pips.
50.
Yes.
Multiply the 50 times 1.5.
Okay.
That is risk reward ratio 1:1.5. So 50 times 1.5, that is 75 pips.
Okay.
And since you are selling, you will subtract that 75 pips from your entry price. If you are buying, you will add 75 pips to your entry price. That will not be your profit target. Is that clear?
Yes, yes.
Thank you. Any other question? Any other question? Do you have any question? If you have any question, please raise your hand up. Let me unmute you. Mr. Ahmed, do you have any question? Ebuka, do you have any question? In my excellency. Mr. Jeremiah, Mrs. Mercy, Mr. Razak, Sema City, Mr. Stephen, Mr. Wakachile. If you have question, please raise your hand up or drop it in the comment space. Sema City, you have a question? Okay. Let me unmute you. Sema City, you're on.
Good evening, sir.
Good evening.
Yeah, thank you for the good work.
Welcome, sir.
Yeah, I am not still very clear on the use of the zigzag because I noticed during trading, or maybe I should say, what is the best time frame to be used for the zigzag? Because I noticed
4 hours.
even 4 hours. Okay, that's the best time frame.
Yes.
Okay, because I noticed I use it 1 hour and I waited for the close of the candle. I still experienced a push up or a push back after the.
Please repeat. I went off. Repeat your question again here.
Okay, I said that what is the best time frame for the use of the zigzag indicator? You just told me 4 hours because I noticed on 1 hour that after the close of candle above, and I still waited for the second candle, I still noticed that price still goes bearish, still goes down. And I also noticed it the other way too. When I Hello? Did you get me? Did you get me?
Sorry, but the network is fluctuating.
Okay, maybe I should type.
No. I prefer just repeat what you.
Okay. I said that I noticed during 1 hour candle. I mean, using 1 hour candle for zigzag strategy.
Okay, let's go to the chart. Let's see it.
Okay.
Okay, we are 1 hour now.
In real life, like take for example where the zigzag is now. You know, is selling. Yes, there.
Yeah.
I noticed that after the close of candle and a bearish candle shows, and I'm waiting for another candle, I noticed that the price still, in 1 or 2 occasions, price still goes up, even meeting all the requirements, waiting for the candle to close underneath the zigzag, and also waiting for another candle to see the direction of the next candle to determine your trade, whether you're going to follow the trend. I noticed in 1 hour, basically. I didn't try it on 4 hours anyway.
Okay. What would you have done here? Zigzag is above a bearish candlestick. Where would you have entered a sell?
A sell. I would have waited for the second candle to close.
You don't need to wait for the second candle to close.
Okay.
In as much as zigzag is on a bearish candlestick, you should sell.
Okay.
It is when the zigzag is on a bullish candlestick, you wait for the next candlestick to close. Because this is an indication that you still have buyers in the market. You can't enter a sell when you see a bullish candlestick. You have to be sure that you have sellers in the market. And how do you confirm that? Is by the formation of the next candlestick after the bullish candlestick.
Okay. I think I got
See
that.
what we have here. Zigzag is below a bearish candle. You wait for the next candlestick to close.
Candle to form
before you buy. Look at the next candlestick.
Okay.
This is a doji. This is a spanning.
It's okay.
This is a spanning bottom. It is after the close of this bullish candle you would enter buy.
Okay.
This is the candle that confirms that you have buyers in the market. You can't jump in with this formation because the sellers are still in the market. But this confirms that, okay, buyers are showing up in the market. Then the risk is worth taking after the close of this candle.
Okay. So the ideal time frame for the analysis is 4 hours.
Yes.
Okay, good. Thank you.
You're welcome, sir. Any other question? Yeah, no question. That will be all for tonight's session. No question. Mr. Wakachele, Mr. Steven, Mr. Jeremiah, Mr. Emmanuel, Mr. Albert, and Mr. Ahmed. So if there are no questions, I would end tonight's meeting. Sema City, let me meet you. The replay will be available. If you've funded your life account with Cabana Capital, just contact your account manager for the replay.
Okay. Sorry, although you said
okay.
You said a replay will be sent to us. Thank you for that, because I didn't join on time.
You have a life account, right?
Yes, I do.
Okay, just contact your account manager and request for the replay.
I'm not sure I know my account manager's number.
Okay, just send me a message on WhatsApp after the class.
All right. Yes, I'm sorry, I came a bit late on where you were talking about explaining about using 1.5 risk reward ratio and 2 or 3 watch video. Can you please quickly do a recap?
The video will be available, so just watch the video.
Okay. Thank you.
All right. Any other question?
Hello, sorry, before you go, when is the
Okay.
MT4 going to come back?
It came up some few minutes ago, but I think it's off now. But I believe before midnight, it should be off.
But is it a usual practice?
No,
What about our live trade running? How would that be addressed?
If there are losses, it will be compensated for. Okay.
Okay.
If you can prove, yeah, it will be compensated. Okay.
If we can prove.
Yes.
Okay. Then I understand that
it will reflect on your history now. So your entry price, and
okay.
We can see it on the chart how price moved. So with that, you'll get compensated. You'll be refunded.
Okay. Then I understand that MT5 is not affected. What's the difference between the MT5 and MT4?
MT5 is just an upgraded version of MT4. Yeah.
Okay. All right. That's all. Thank you.
All right. Thank you.
You're welcome.
All right. I want to appreciate you all for your participation in tonight's class. If there are no questions, then I would have to end this meeting. And like I said, the replay would be available. All you have to do is contact your account manager and request for it. Thank you very much. Do have a wonderful night.